Hello, everyone. Welcome back to the TraderLion podcast. I'm your host, Richard Moglen. With me today is Mark Ritchie II, who, along with Mark Minervini, David Ryan, and Dan Zenger, was featured in Momentum Masters. And he's also the managing partner over at RTM Capital Management. Mark, thank you so much for taking the time to speak with me today, and welcome.
Richard, thanks for having me. Thanks to TraderLion. Looking forward to it.
My pleasure. Our pleasure. And to start things off, I love kind of hearing about how people got interested in the stock market, first introduced to trading. And I know that your dad, of course, he was featured in Market Wizard as well. So I'd love to hear if he had a big influence on your trading style and methodology. But just in general, how did you first get introduced to the markets, and where did you get your start?
Sure. So actually, I wouldn't say it was my dad in terms of trading, ironically. And, for most intents and purposes, that style of trading, in terms of the floor, commodity trading in pits, yelling and screaming, and the stuff you see in movies like Trading Places, was pretty much gone by the time I was really interested in it. Not entirely, but a lot of the action was electronic. I've never traded on the floor, visited there a number of times growing up, that kind of thing. And my dad was sort of functionally retired really by the time I was in middle school, high school. So, but there was, a strong bent towards games of chance, probability, math, that kind of stuff. Certainly, if there's an area he's had the most influence on, it would be those types of things, in terms of strategy and critical thinking. My actual background, I guess, in terms of formalized training, would be in philosophy. So I don't have an MBA. I don't have a finance degree. I've never taken a formal college class, in any form of finance. So mine is more of I really just needed a job, is the short story, when I was a few years out of college, and an old associate of my dad's basically hired me to kind of be a assistant, if you will, placing trades, monitoring positions, that kind of thing. And I've told that story a time or two, but the short story is that ended horribly bad in terms of that whole operation was just sort of went up in flames. But during that, that's where I got really interested in the markets.
Yeah.
So just, I would use the phrase, kind of caught the bug, or got interested in realizing maybe there is a game here, for lack of a better word, or a strategy game that I'm really interested in, and just kind of becoming just fascinated with why do markets do what they do? Why do they go up and down? That type of thing. And then specifically, can I find something that really works? That was more the sort of two prongs, the way I was looking at it at the time. Anybody that watches markets to some degree is always wondering, well, like, why did this thing rip today? Why did that thing tank today? What's really going on here? And it could be anything. For me, in those days, it was more futures and options. I wasn't even trading equities at all, more derivatives, but just kind of getting that whole bug. And then, so there's that side of it. And then, the other side being, is there a strategy to take advantage of this that's sort of repeatable? Right. Not the shop, if you'll call it that, I was kind of working in. It was really more of like a 1-2-man prop operation. It was, there didn't seem to be a lot of rhyme or reason, at least in the way that approach was going. So I was just kind of interested in what's really going on, and then I, developing some ideas that I really wanted to try. And so in really late 2009, about beginning of 2010, I kind of just borrowed a little bit of capital and said, let's give this a shot. So that's that's the rough cut story. I can provide more color if you want, or we can just go from how things evolve from there.
Yeah, I'd love to hear kind of the key turning points. And obviously, I know you're influenced a lot by Mark Minervini, the Master Trader program. I'm sure was a part of your journey. So I'd love to hear about kind of how you turned up the performance and really got to the methodology that you currently use today.
Sure. Well, Mark was a major influence, of course. And even before that, though,
Hmm.
and this is one thing, that somebody like Mark or a lot of guys in market wizards you'd hear them say is the idea of doing more of what works, in markets, which seems intuitively obvious. However, you'd be surprised how many people like to continue to do things that don't work. You know what I
Yeah.
mean? Buying stocks on the 52-week low list or hanging on to losers and things like that. Um, so, in really, it was a process of trial and error originally.
Hmm.
And I kind of started out with just some ideas that were really more purely quantitative,
Hmm.
where it was, for lack of a better word, almost like systems that I'd sort of developed with actually my brother at the time was sort of he was like the research guy. He was the quant, and I was going to do the executing and the portfolio managing. And uh, very quickly, I realized that it's not that I couldn't follow the rules,
Hmm.
but it was more the idea of feeling like the quantitative, being purely quantitative, was not for me. And what I mean by that is where you sort of just set some type of black box that says buy here, sell there, and
Right.
just follow the rules. I had no problem following the rules, but the in sort of the discretionary, intuitive side of me was just looking at markets. So when you set a model to just trade or whatever that looks like, whether it's automated or not, you just buy and sell when it tells you to do it. And there were things outside of the model that I'm just watching markets going, I think this looks like it wants to go higher, and yeah, I want to buy it. So it was actually my one of the pieces of advice my dad gave me was, look, you got a couple of strategies, give them all a risk budget within your portfolio, manage them each, and see where, sort of let the score
Tell you
settle
where to
the
go.
issue.
Yeah.
Exactly. So to the point of then if it just treat strategies like employees, promote the ones that are doing the heavy lifting and fire the ones that show up late and do garbage work. And so at the end of my first year, I had two strategies that did over 100%.
Hmm.
Uh, Unfortunately, I'd given them the least amount of capital at the beginning,
Hmm.
but it's not unfortunate when you realize very quickly, like, if I have an edge
Yeah.
and I can turn it over, or I can continue to take advantage of it, eventually, if you put more and more capital that way, you're going to wind up ahead, hopefully way ahead,
Hmm.
which in my case was the case. So one of those happened to be, I was basically just doing some swing trading,
Hmm.
and I buying breakouts, for lack of a better word, in equities. And around that time, I stumbled upon, Mark wasn't uh, formally even, he was just kind of starting to sell some research and do some education and that type of thing.
Yeah.
And to say like, hey, I took, like, to his sort of style, like a duck to water, would be a little bit of an oversimplification, but it made sense to me.
Yeah.
And I had no idea. Originally, I think he was just putting a few ideas out, like on stock twits. This was before Twitter, and he didn't have any books, and there was no master trader program or any of that kind of. He hadn't really created. His stuff is really more almost like a branded school.
Yeah.
Sort of his methodology, which is based on, and if you read his first book, it's not like he invented this stuff out of thin air. He studied a lot of other guys like William Giller and Edward Jensen and William
Yeah.
O'Neill, Richard Love, and has just sort of taken this and from here and tried to really make it
Refine. Yeah.
refine it, yeah, to make
Yeah.
it specific. And to me, the idea though of low risk entries is really where I come down even more so than anything. That is, to me, has always made sense. If you I don't care what it is. If you have a strong opinion on anything, great. Just marry it to a low risk entry with a stop that tells you when you're right or wrong. And ideally, then it's refining that piece of things. To me, the most powerful stuff is where you can say, okay, I have, whether it's a stock, it could be, if I was teaching people how to trade markets, I don't even understand. I would be saying the same thing. I would say, look,
Yeah.
you need to figure out a low risk entry. Why? So that you know quickly whether you're right or wrong. So you can move on and
Hmm.
quickly take quick losses and turn the capital over, or move the capital to where it's going to be more efficient. That's, I think, what people don't understand. They don't want to take losses, and so they sit with positions that aren't working, or let trades turn into losing trades turn into investments, which is the worst thing you could do, because they don't understand that this is a game of market efficiency, moving your capital to where it's going to be proved to be most efficient next, which is ideally stuff that you think is going to move in the direction you want it to move. And so finding those lower risk entry points, is just a great way to do it. And that's something that Mark's, a master, quote unquote, at teaching. And so, yeah, at the end of really became a couple of years, that just became one of the dominant approaches, for lack of a better word, in my
Hmm.
portfolio. And that would be, it's on any time frame, meaning, so even if you were going to make me trade 1 minute charts, which I never trade, I'd be looking for I'd be looking for the who knows, maybe a tick wide, or a few pennies, in terms of a tight entry. Where if I'm trading on a weekly, I'm still going to look for a tight entry on the weekly chart. Well,
Right.
everything, in relative symmetry to itself. And this is where I think people have to define themselves. Even if I had to be a long-term investor, I would be looking for what I consider a low risk entry on sort of a longer term time horizon. So if I'm not trading on dailies or intradays, maybe my stops are a little bit wider, but they're going to be tight relative to the expected move I'm looking to take advantage of.
Perfect. And just going back to what you said, with regards to systems where you're picking one, seeing whether it works well. If not, move on to the next thing. That also seems to be pretty much your approach to positions. Also, if they're not working for you, get rid of them. Try another low risk entry and see if that basically stock or equity is successful.
Sure. I mean, that's a little bit of an oversimplification, but I
Yeah.
think that's exactly right.
Yeah.
The idea though of, I don't want to keep anything in the portfolio that's not working on some level. So there are some positions over time. So, as my account's grown, and as I've sort of learned in terms of what are the characteristics of big winners, or spotting them in real time, where my timing's been good. There are times I try and play some positions out for bigger or longer term moves,
Right.
but the entry points are going to be the same.
Hmm.
Where, let's say there's a position I bought and I'm trying to give it some room to play it for a bigger move, I'm still going to be at a profit, even if it's going sideways or potentially even pulling back and hasn't hit a stop yet. So I've still cushioned myself with gains in that position. The way I like to do it is, ideally, let's say I buy a breakout, it works well, and it's in a group that I understand and that I think is a sort of classic growth group with good fundamentals. Then I'm going to try and finance that hold with a portion of the position. So
Hmm.
I will sell part of the stock, and use that to lean on to try and play it for a bigger move. So even if then obviously moving my risk control or stop up.
Yeah.
So even if it comes back, then I'm still net at a positive outcome, and trying again. So let's say, I buy a stock at 50, it runs to 70, and I sell half or three
Yeah.
quarters of the position. Well, that stock may pull back to 60, which would be normal. And I might keep it in the portfolio, but I'm still up on it. I'm not just keeping it around because I like the fundamentals.
Yeah.
The mistake people make is they buy a stock, it goes down, and they go, well, I really like it, and then they keep it around. That's, I'm never doing that. And when I say never, I mean never.
Yeah. Perfect. And something that I don't think a lot of traders don't fully grasp until maybe they even blown up an account is proper risk management. So can you talk a little bit about how you pair both position sizing and setting that initial stop loss and managing your stop loss to kind of control your risk and make sure you're never going to go into too much trouble just taking a normal stop loss hit?
Sure. Well, look, this is the most important aspect in terms of uh, ensuring yourself that you're not going to get, in huge trouble.
Yeah.
And look, I don't want to say I've never known anyone who's blown themselves up using tight risk control, but I'm not aware of any traders that have taken the approach sort of that I would take, where is to say, look, if I'm going to have a bad period, it is not going to be because I took one big loss. It's going to be
Yeah.
because I took tons of small losses, meaning, and then coincidentally reducing my risk per trade as those losses are sort of piling up. So
Right.
if I get hit on 2 3 trades in a row, I'm immediately going to
Scaling
be,
back.
be most
Yeah.
likely, yes, trading smaller on my next trade or two until I see things moving the other way. And look, lots of people talk about this and it feels intuitively obvious, at least to me, but I'm shocked how many people just don't do this. They go, well, I lost on two. I'll trade the next one bigger. I mean, the market is either you're out of sync or the market's bad or both, or your
Right.
strategy is no good, which is even worse. You should be, you have to, you have to respond accordingly. Think of the market as your dancing partner. It's
Hmm.
stepping all over your feet right now. And you've got to take a step back and go, we've got to get in sync here before, you know, we try any complex moves or, in terms of what does that translate to? Bigger sizing, aggressive trading. So, yeah, the way I handle it is, look, the better things are going, the more aggressive I want to be. Whatever analogy if you're a baseball guy, you hear baseball players talking about, I'm seeing the ball well. If you're a football player, it's like I know right where the defense is going to be before they're there. It's like everything is clicking. The
Hmm.
race car driver, it's like he is coming out of the turn perfect and gassing it into the straightaway, and he's riding the brake at the right time. You know, so all these analogies, are synchronous in some ways, but I want to be trading as aggressive as possible when things are working. And what I mean by that is it might not be that everything, all my trades are working, but if all the timing is lining up,
Hmm.
so the fundamentals are really good and I really like the technical setup and I'm at or near equity highs in my account, I want to be trading aggressive. If my last few trades are, not showing much progress, I'm underwater, or the market just isn't showing me what I need to see, then I'm going to take a much more conservative approach. And the other thing is that I think people don't appreciate is that trades are not evenly distributed. So if you're this gets a little into the math and
Hmm.
stats, but if you're somebody who I tend, on average, I will lose more than I win, meaning I tend to be profitable about 4 times out of 10.
Yeah.
Uh, well, so people would just think that normally that means, it works out close to even. I win, I lose, I win, lose, 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 win, lose. You know what I mean? That's not really how reality works. So that 40% distribution over 1,000 looks very chunky at times. What I mean is you'll have periods where you might win 10 in a row and lose 15 in a row. I want to use that to my advantage.
Hmm.
So where if I go into any type of period where it feels like losses are starting to stack up, I want to crimp it off as quickly as possible. And part of this is the nature of, if you're a swing trader like I am, or favor the long side, say in equities, you're going to have periods where the markets are just good and everything's
Yeah.
kind of working as institutional capital is flowing into certain areas and you
Yeah.
catch those low risk spots. Well, that's when you want to quickly you know, sort of have a pulse on things. And, I get the question a lot, like, how scientific are you in terms of ramping up and ramping down? It's like, well, very scientific in the sense that I want to do it on the heels of success. So
Yeah.
if I'm not making any money, I'm not going to get more aggressive. But it's also a little bit of intuitive and artistic to say, am I seeing the picture I want to see, and the traction I'm getting in my own positions to sort of step on the gas, and then just as quickly, if I get it wrong, I got to get right. I got to jockey back and forth sometimes to sort of get positioned properly. I don't know if this is making sense, but
Oh yeah, it is.
that's kind of the artistic side. But all this to say, look, you want to be trading as aggressive as possible when things are going well, and this is something I think any good manager, and you read about this in Livermore's writing. Stanley Druckenmiller talks about this. Mark Minervini talks about this. Lots of, for lack of a better word, directional traders. If you're trading in the direction of the market, um, this is a commonality that I think a lot of the successful guys talk about.
And that goes a little bit into discipline and also just being aware of your results. Because as you mentioned, a lot of people like to revenge trade. They lost twice in a row. Oh, they need to make it all back right now. But instead, they should kind of listen to that market feedback, as you said, and recognize that their system, they're out of sync, all of that. And they need to step back, have their position size, and just wait it out until their performance improves, and then you can push a little bit more and try to get that alpha out of the market.
Sure. And well, look, revenge trading specifically.
Yeah,
Why would anybody do that? Well, it's an ego thing
right,
often.
right.
I can get it right back. I can, um, nobody, I shouldn't say nobody. I don't mind taking losses. I don't particularly enjoy it. But it's a cost of doing business. I
Right.
don't take it personally though.
Hmm.
It doesn't mean, at times, look, if you're going to be making new equity highs and continuing to try and grow your account, theoretically, your biggest drawdown is always ahead of you.
Yeah.
Well, you better you better get comfortable with that. Um, because that is just that's another cost of doing business, assuming that you can continue to scale your edge. Now,
Yeah.
there's always liquidity and size limitations, but my point being, look, this is this is something that everybody has to deal with, and some guys, they get to a point where they their accounts, they're comfortable at a certain size, and they just want to trade that size and kind of cream profits. I think
Hmm.
that's great. There's absolutely nothing wrong with that, and I know plenty of traders who do that. And then there are other guys who, for whatever reason, feel like, hey, they want to continue to grow, and continue to try and, manage a larger sum of capital. Uh, in either respect, though, the whole um, emotional impact is theoretically gonna creep its way in there either way. And I think, removing your ego and not taking losses personally, we can talk about that. There's always going to be that temptation, especially early on, to let those things destabilize you emotionally. And I think
Yeah.
that's the biggest thing. This is why I think it's important not to even track dollars versus percentage points. You know, if you say I lost 2%, for whatever reason, when guys go, I lost 2 grand, 200 grand, 2 million, at some point they start to think about all the things they could either buy
Yeah.
or spend that money on, or, it just, rather you go, well, I lost a couple, I lost a few percentage points. It doesn't seem to have, that emotional appeal. That's why I always encourage people, even in terms of tracking your trading, do it in terms of percentage points. The other point I would make, though, is, if things aren't going well, like Mark Minervini is a good example. He often says, if you're having trouble in the market, there's one of two problems. Either the market for your strategy is not good, and it doesn't matter. This is something I tend to just believe almost philosophically, fundamentally, about a market. No strategy works all the time. I don't care if you are a quant guy trading on, I don't know, for little ticks, versus somebody who is a long-term trend follower, mean reversion guy, doing stuff, value growth, you name it.
Hmm.
Nothing is going to work all the time. If it did, that person would theoretically own the world. There are going to be periods where certain strategies underperform or don't work. And that's why they work, because they don't work for a while, and that rinses out, certain players and sets up opportunities for other guys. And if you can just keep your head above water, while your strategy isn't doing well, you're going to do great, because you go up and then you go sideways and you go up. Well, the other issue is, if things aren't going well, guys like Mark will say it's either the market is bad, meaning it's not in sync with your strategy, or your strategy's bad.
Yeah.
I add a third element where I say, or you're bad, meaning that you are not in sync with your strategy in the market. And this
You're not
happens.
executing. Yeah.
You're not executing for whatever reason. And it might be because you're actually not a good fit for the strategy itself.
Right.
This is something obviously lots of people talk about. You got to find a strategy, suited to your personality. Well, or you need to make some changes in terms of how you are thinking about the strategy. You need to work on your emotional control, or your preparedness, so that you're ready to take advantage. This is why, whether it's lack of focus, lack of discipline, it's not the strategy, it's the operator. In some cases, that's the problem. Like I use the analogy sometimes. Look, when the third baseman who commits an error and then looks at his glove, it wasn't the glove that committed the error. It was the guy holding it. And so all three got to be in sync, meaning I have to be in sync with the strategy, and the strategy got to be in sync with the market, in order for things to really be working. So that's a question I often ask. Like, okay, now I believe the strategy I'm doing, it works. I think our record, and plenty of other people's record that are in similar type lane on the highway to me, has proven that works. So then the question becomes: is the market, not? Is the market just bad, or am I not operating the strategy correctly? So those are sort of the two places I go, and hopefully it's just the market's not in a good period. But we can get into what that looks like. But in terms of periods that are not optimal, and usually the way I determine that is because your things are not working. I.e., if you're a breakout trader and breakouts aren't working, that's all you need to know.
Yeah. Yeah, no, that's excellent. And I wanted to ask you earlier if you had any kind of book recommendations for new traders starting out, that you think would really set people on the right path to defining a bunch of systems that have worked in the past, and they can kind of find out what works best for them.
Sure. Well, boy, for me, I started with Market Wizards
Hmm.
generally. Those were kind of like the Bible, if you will, in terms of just the gamut of success, different personalities, different strategies. Some of those Market Wizard interviews I probably read, I don't know, 30, 40, 50 times. Those are great. Obviously, anything by Mark Minervini is great. I think, in Momentum Masters, that was one of the questions. What are some of the books? That was before I think Mark's second book even came out. That one's probably of his one I like the best, I would say. William O'Neill, obviously. Look, there's a number of great books that reminiscences, some of the classics. And I'm sort of increasingly in the camp. I've read a lot of different trading books and gotten different things out of them, but like I was saying, even in terms of some of the Market Wizard stuff, I've found it more valuable sometimes to go back to the good ones and reinforce those ideas, especially if you find yourself towards a certain strategy. Look, if you're a value guy, I don't know anything really about value, but you should be reading Ben Graham or, Joel Greenblatt, or, whoever the guys that have done incredible stuff in that
field.
lane, for lack of a better word. I have no idea, who the quant guys read, because I'm not a quant. But yeah, I've found that revisiting some of the,
The
sort of
classics. Yeah.
the classics and hammering those into your head is better than looking for, I don't know, some other book written by somebody maybe that really hasn't even traded. At least that would be my view. So yeah, I don't, you can look at what I recommend. I think in Momentum Masters, again, I recommended Mark's first book. I did recommend Pitbull, I think, by Marty Schwartz.
Yeah.
That one's kind
Yeah.
of fun. That was more entertaining, really, than you're not going to get a lot of strategy stuff out of it. And then, yeah, for me, the sort of the O'Neill, the Minervini, type books.
For sure. And is there anything specifically related to mindset or trading psychology that you've read and really recommend and yeah, on that side of things, basically?
Not necessarily. So I wouldn't say it was something that I read.
Hmm.
But there is sort of an interesting. So I didn't put a lot of stock. This is more of an interesting story and anecdote than it is, hey, read this and it'll help you. It'll help you in your trading psychology. But before, so Mark and I became friends later on. But he put on one of these like little contests or whatever early on, and I signed up for it, competed, and was fortunate enough to win. But I didn't really know him. And he did a webinar where he was just talking about uh, this kind of topic in terms of, your psychology, personality traits, your mental framework, that kind of thing.
Hmm.
And he said, well, let me tell you about this guy, Mark Ritchie, who just won this, trading competition I put on. And I happened to be listening to the webinar, and I was like, well, this should be interesting because this guy doesn't know me. Like, we literally had shook hands one time and spent zero time together. So that seemed a little off, that somebody would say that. And I happened to be watching it with my business partner, or listening to it. And so he said a couple things about me that I thought were spot on and kind of interesting. This guy's really disciplined. He's non-emotional. He doesn't worry or panic. And just a couple of things. And he might have even said one, something even more specific. And I was just like, to the point where the other guy in the room was like, how in the world does he know that? It was just almost
Right.
like a little bit of an eerie feeling of somebody saying something about you that like that literally spent no time with you. And then so a number of months later, I happened to be in his office, and so I asked him about it, and he said, look, I've seen your trading. I looked at your buys and sells. That's all I needed to know.
Hmm.
That this is a reflection of your personality. So you show me somebody's trading, and I can tell you what kind of person they are. And that was just like a realization in some sense that we're all bringing who we are to the table in this game, for lack of
Right.
a better word. And you notice this if you track your own trades, because what you see is we have tendencies. You hear about this. Anybody that's ever done this exercise will go, I have a tendency to hold my losses too long, to cut my winners too short, to, all that kind of stuff, to second guess myself and get out of things when I shouldn't. Well, those are all function of personality. And there are going to be things inevitably that we do better than others. So that it really is true that trading becomes an expression of who we are, which is why, in some ways, this is the ultimate game, or sort of bet on yourself,
Yeah.
and where you have to make some. You have to identify what your strengths and weaknesses are, and then make some adjustments accordingly. So it wasn't the discipline of necessarily reading anything, but more of just going through sort of like a real-time discourse with someone who is a lot more experienced, and saying, look, if you don't think that, your trading is a reflection of your personal psychology and the way you're viewing things, and, your personal discipline and so on, then you're kind of fooling yourself. So I think there were certain things I had in some ways maybe I don't want to say a natural ability to do, but like, taking losses, for example, has never been an
Yeah.
issue for me. I don't know why. I couldn't sit there and explain to you why I don't have a problem taking losses. It's just something I just, I don't get wrapped up emotionally in it,
Right.
where other people do. Um, so yeah, that was more of like, it just sort of like opened a door to say, oh, interesting,
Mhm.
that these markets really are a reflection of sort of even collective psychology. This is why do markets sell off a lot faster than they rally? Because everybody tends to panic in
Right.
a similar way. Um, nobody at new highs screams, "Oh my gosh, you have to get me out right now." If anything, they just kind of hang around. It's once they start losing, that people do things that are irrational, Um, and so, yeah, if anything, just it almost just illuminated like what ultimately drives buyers and sellers,
Mhm.
in sort of in real time, if you will, and then gave me a greater appreciation, I think, for potentially how to coach or help people as well, because often that is people's hangups, is they've got um, a lack of confidence in their analysis, or the inability to stick uh, with their plan.
Right.
They put the plan together, it's a good plan, but they can't follow it. uh, that isn't something that's resonated with me personally, but those are the type of things people have to work through if they're ever going to have a chance at really being successful.
Perfect. And could you tell us a little bit about how you personally like go ahead and study your own trades and do post trade analysis? Because I think people often hear that you got to study yourself and find your strengths and weaknesses and try to double down on your strengths and try to minimize the weaknesses, but they're not quite sure about how to actually go about it and study themselves. So I don't know if you're willing to share your process or just kind of give some guidelines on general post trade analysis.
Well, I think, one, you got to track everything. That would be
Hmm.
the first thing. I just look, do the work. Some people don't like doing this. Listen, if you're crushing it in the market, and I know some guys who've been doing this long enough that they don't track stuff anymore because it's almost just like it's second nature.
It's ingrained, yeah.
Yeah, it's just ingrained. I'm not there personally, and I want to see tendencies even within our own trading, or what has been working in the market, say, expressed by our own trades.
Yeah.
But if you're new, you've just got to track everything,
Hmm.
and then look for those patterns within your own trading. So there's nothing there's nothing fancy. I just use Excel, and then I'll put a few notes in there. I think it's best sometimes to look at them maybe a little bit removed,
Yeah.
say a few months or something like that, where you can go back and go, well, why did I buy this? Why did I take profits here? And that's where putting in the notes why you did something, because sometimes it's always, you want to be as non-subjective as possible when it comes to grading your trades. You
Right.
can always nitpick yourself. That's not the goal. The goal is to say, okay, was this a good buy or sell if you're shorting or whatever? And this is true. I don't care if you're a discretionary trader. I don't care what your go-to strategy is. I would say the exact same thing to somebody who's doing something completely different. This just has to be a part of your process to say, okay, why did I buy this here? Did this fit with my plan? Did I follow my plan? Um, and then looking, back, rather than to say, well, did I sell the high, or did I maximize the profit? No, did I follow the plan? Did I take
Right.
profits at maybe a multiple of my risk if that was my goal? And But looking for, I think some people tend to even trade a certain style better. Some guys like to buy breakouts to new highs. Some guys like to buy pullbacks. Some guys do well at both. Some may find, and this is where, in tracking my own trades, found that, well, within certain types of setups, I may want to look to go for a bigger move because I'm
Hmm.
consistently selling these too early. Well, if I'm labeling all that and tracking it, I'm not just making it up.
Right.
This is borne out by the data. And one of the reasons now, so a good example would be early on, I was exclusively a trader, meaning I got a 2 to 1. I just sold it, just kick it out, turn the edge over, move on. And if that's the best way, in my opinion, to grow a small account is compounding small gains. If you can count, if you get a coin flip and it's 50-50, two times, you win on heads, you lose one on tails. To me, it's just a game then of how many times can I flip the coin.
Right.
The more I flip the coin, the more I can turn the edge over. Use whatever analogy you want. Guys on blackjack, it's, if they think they got an edge, they're trying to play as many hands as humanly possible.
Right.
Well, that was the game I played for a number of years. Then after studying multiple years of just trades, I went back through and looked at every above average gain trade I had and studied them to see what they had in common. And I found that a majority of them were in the classic type growth groups that guys like Minervini and O'Neill had been writing about for years. So I didn't make it up. It was like, wow, I did better in tech than I did in commodities.
Right.
Even though maybe they had the same technical setups. I did better even trading, but then I also noticed that when I sold them, they consistently went higher over the next, say, weeks to months. So that told me, all right, if I catch one of these properly, I'm going to potentially look to hold portions of those positions for bigger moves. So you sort of become a little bit of a trader and an investor.
Right.
At opportune times. I'm not looking to be an investor at a late cycle in a bull market,
Right.
but certainly towards the beginning. And that's how you continue to evolve, and then hopefully able to continue to scale up your operation. At least that's how I've done it. But that was sort of a powerful aha to say,
Right.
okay, if I see these criteria and I time it right, I'm going to potentially look to hold a portion of this position for longer than just a trade. Where normally, to me, a trade is I'm at a multiple of my risk, I'm taking the profits.
Hmm. Perfect. Yeah, that's really cool to hear. And are you someone who prints out your charts and kind of marks up the buys and sells, or do you do it all electronically?
I haven't prior, and this is something actually we just put it in Excel. Well,
Yeah.
so what I noticed, probably say after 7, 8, 9 years, I was going back through and I'd bring up an old symbol and it's not there anymore.
Right. Right.
Stock it doesn't exist because it maybe got bought out, maybe most likely went out of business.
Yeah.
And so, yeah, I started in the last year or two to say, okay, some of our better charts and trades and examples to print those out. That's something, I've done newer. I've always tracked them in Excel, but now, yes, taking some screenshots or sort of creating your own chart
Chart
books of your
book.
own
Yeah.
trades. Yeah. That's something in the last really last year or two that I've been doing sort of on an annual basis.
Perfect. And my favorite thing to actually ask the traders who I interview is basically ask them about their daily and weekend routines, because I think that illuminates a lot about the discipline and the consistency you need to set yourself up for success week after week, day after day. So I'd love to hear about first kind of your weekend routine. How do you identify your focus list for the next week? And then also later on, how you execute on the daily.
Sure. So weekend usually for me, I tend to do a lot of that. I used to do it on Saturday or Sunday, evenings whenever I had time. Normally, I'll do it on sort of Friday afternoon, evening. It just depends. I'll do a little bit more work on the weekends, running a few more screens.
Hmm.
But a normal daily routine for me is, I tend to do, I start, hour and a half before the trading day or before the opening bell.
Yeah.
And then I usually, I quit. I tend to quit, a little after the close, and then go over all my lists and screens kind of pre-market. So I've got if for lack of a better word, like I never go into the day having no idea what I'm buying. That's crazy.
Right.
And I'm sure that's a commonality. I've never heard of anybody who does that. That's you have to have a playbook or a battle plan, however you want to think about it.
Right.
So yeah, normally my day, I get up usually half an hour to an hour before I would start work, spend some personal quiet time, and then I start my day around 7 Central, spend about an hour and a half going over all of anything. I think, we're always running what I call like a primary and a secondary watch list. Secondary watch list is anything that I think is maybe close to buyable,
Right.
and that's based off our screens. So think of it in terms of I've got I sort of got the cart before the horse there, but I've got a number of screens that I run that are anywhere from say 3 to 700 names
Mm-hmm.
that I run every single day. Cull that down to a secondary watch list of anywhere from 50 to maybe 100 names or 150 names as much. And then off that, I'm looking to form like a primary watch list. That's stuff that alarms are being set on that I want to watch in real time if they're moving through certain prices, and that are potentially actionable. And then because I have a co-portfolio manager, we go through the
Mm-hmm.
same process separately. And then it's sort of like, okay, what are we seeing on the primary watch list for today? Usually we got 90% of the same stuff. He may have one or two I don't, or vice versa. And then we set the alarms, and then go over potential, what are our total exposures? What's the total risk we're carrying? What do we potentially want to add? Or, where do we want to reduce things, either into strength or weakness if things aren't acting well? And that's something we do intraday as well. So let's say we've got, we're really long. We've always got sort of calculated points in terms of sort of in each name and even kind of on the overall portfolio to say, hey, where do we going to start reducing risk here? Because I think one of the biggest mistakes people make too is they potentially get themselves invested properly, but then then the market they allow the market to put them under too much pressure, or then they're
Right.
surprised when everything hits their stops and they go, wow, I wasn't expecting to take that big of a drawdown. It's like, well, you need to account for the worst case scenario. Well, the worst case scenario, if you're long 5 stocks, is everything stop gets hit over the next 1 to 2 days, or maybe today.
Yeah.
How much
Yeah.
risk are you carrying? So we run those numbers. We may not run that every single day, but we at least have an idea in our heads of where that's at. Or I'll say to Brandon, my co-portfolio manager, where are we at? Everything to stops, meaning like, how much are we carrying right now?
Yeah.
So yeah, that's pretty much it in terms of there are sometimes we'll run some screens intraday as well, but normally the plan is kind of set for the day. We know what we're going to be looking at. There may be some names, like let's say they're positions we own and they're acting well. We may look to add to those, but even that generally is probably already on our radar before the day starts. It's pretty rare that nothing comes out of left field, Richard, to just go,
Yeah.
oh yeah, I'm going to buy this now. You know what I mean?
Right.
That's just not how we do anything. So yeah, it's taking a wide universe and slowly culling it down to what we think is going to be tradable. And then the other point I would make though is sometimes we do the work and there's nothing,
Right.
and that's fine. In fact, I would rather do nothing a lot of the time if it means that when I am doing something, I'm potentially really making a lot.
Right.
I would love to make our return for the year in a few weeks
Right.
and just sit the rest of the time, be out of harm's way and bide time. And that's something, that's something that I think is very tough for a lot of people to do, especially nowadays. I think
Yeah.
because of Twitter and, and the financialization globalization of trading and everybody's just FOMOing all about like this thing and that thing or whatever. You hear hardly anybody talking about, hey, why don't you just take it easy and do nothing and wait for that opportunity or that fat pitch or however you want to think about it versus feeling like you got to trade, every wiggle and every tick.
Right. And I've a lot of the traders who I've talked to, they kind of say there's really 2 to 3 golden periods throughout a year where the easy money, the big money is made, often coming off the back of corrections. What are your kind of thoughts on that? And a lot of the other times you're just kind of chopping yourself up and not making a lot of progress for a lot of effort.
Sure. Well, I mean, I think that quote comes from Jesse Livermore, said it,
Yeah.
100 years ago or something like that. I think he even said, yeah, the market's healthy 2 to 3 times a year.
Yeah.
Expose your capital in those times. Play defense the rest. I think most like Peter Brandt talks about the Pareto principle, the idea that like 80% of your profits comes from 20% of your trades.
Yeah.
However you want to think about it, most discretionary traders are going to fall into that kind of a bucket at the end of the day. So yeah, I would agree completely. And that's just something, again, people are going to have to adjust themselves, to sort of psychologically, like trading, unless you're some type of a day trader. But even some of the day traders, it's like they tend to make all their money, I think, on their best days, which are,
Right.
they might be profitable every day. Well, not every day, but they might be profitable, I don't know, 7 days out of 10, but their most profitable days account for 80% of their gains. So I would still
Exactly.
argue it still kind of works out that way. And that can be tough for people to adjust to. They want trading to be like some type of annuity that pays in the exact same amount every single day.
Yeah.
It normally just doesn't work that way. So yeah, I would agree with it 100%.
Perfect. And kind of the last question I have before I'd love to go over some charts with you is when you're going through different ideas and those lists, how do you pair both fundamentals, earnings, sales, margins, that type of thing with the technical setup? And how much of a weight do you kind of give to fundamentals versus the technicals?
Great question. And this is something that's been in evolution. So,
Yeah.
I mean, the funny thing is, I didn't even look at, for the first couple of years, I didn't even look at fundamentals. Um, I did not look at, I mean, I didn't even have, um, I was so small and poor. I shared a Market Smith subscription, and I would just get the symbols sent via Skype, which I would load into another computer. I didn't even
Yeah.
have the fundamental information. So this idea that if you don't have everything, you can't make money, I think that's absurd. I'm proof that that's not the case. Again, though, I wasn't playing anything for a bigger move. I was just looking to
Swing. Yeah.
grab that quick alpha and turn it over. So how do I look at it in terms of the fundamentals now? And this is something where going to the Master Trader program, even multiple times, like especially listening to co-instructors like David Ryan, who, it was funny, like you listen to him and somebody and Mark talk, and where David, if it didn't have earnings and sales, he just doesn't touch it. I mean,
Right.
just disciplined in that regard. Where Mark would say, look, I'll trade the technicals without the fundamentals. Ideally, I'd like to see the fundamentals too. Where David was more of a stickler. So I kind of took a little bit of a hybrid between the guys to say, well, if they both line up, then why wouldn't I try and play this one for a bigger move potentially? And so that's kind of the way I look at it, a little bit like a slide rule, where I will never trade something just on fundamentals. If the
Right.
chart's lousy, I don't care how good the fundamentals are. It's like, I think of it in terms of the weather. You and me want to go out sailing and there's no wind. Let's just wait for let's wait for the wind,
Yeah.
to show up. I don't want to head into a headwind. And anybody who goes, well, yeah, but if you wait for the technicals, you might miss the first 20, 30% of the move. Fine. I'm fine with that. I'll miss the first 100% of the move. Because if it's truly going to have a big move, I'd like to catch a chunk in the middle
Right.
where I think there's less risk. So that, and do you run the risk of it never setting up technically? Sure. Well, that's the sacrifice you make for trying to wait for a good low risk entry point. And if you want to try and catch everything that's ever going in any one direction, that's a fool's errand anyway. So I'll always wait for some kind of technical confirmation. And the best ideas, though, for me, are really when you see both line up nicely. So let's say
Yeah.
though that there's something that is it's in a good uptrend, but it doesn't have a really tight entry point. Something that I'm looking still, but I maybe I've the fundamentals are great, and it's in a classic growth area that I want to get involved in. I'll potentially trade it on a technical setup that maybe isn't quite as tight as I'd like to see. So I'll give it a little, it will still fit
Yeah.
within, the overall technical picture I'm looking for. I just might not be quite as precise. And I might take a little bit of a smaller position,
Right.
but I'm never going to sort of break discipline just again because I like the technicals. But the best situations then are ones where everything kind of lines up,
Right.
where it has either earnings and sales or both, and it's in one of these sort of classic growth areas where you see some of the bigger winners come from.
For sure. I 100% agree. I think last year it might not have been my best winner, but a lot of people made a lot of money in Tesla, and that was kind of one of those instances where it had a lot of super tight entries where it just was a classic VCP type entry, but also it had the earnings, the sales, the story, the EV theme, and that's actually something I wanted to ask you. Do you favor a top down approach? Actually, I read Momentum Masters and you talk about this, but I'll ask you anyway. Do you favor a top down approach where you're looking for the group that's strong and then look for stocks within that? Or do you start with the stocks and then kind of let that point you towards the area to focus on?
Yeah, it's always the stocks. I mean,
Yeah.
this is really where I my default position is that the market knows more than I do.
Yeah.
Market's smarter than me, so why not just let it guide me to where the money is going? And that also means that there might be times where, again, to my point earlier, there's just not much to do because if the market's guiding me to if the strength is moving me into areas that are defensive, then I don't do as much. Or
Yeah.
cyclicals I don't favor as much. I really because I don't have as good a record trading those.
Right.
um I'm, you gotta dance with the girl you bring to the dance, and that's kind of those growth areas, at least for me. So no, it's always stocks, and then you sort of see the theme. And the one thing though I will say is, if there have been times where I've had some decent trades, even in areas that aren't growth, it's because I've seen lots of stocks in that area.
Right.
So probably the last really good example, like there's been two periods over the last 10 where I've had pretty good trades in gold and precious metals. Well, it was because there were tons of gold stocks setting up.
Right.
And that we saw that last year right after COVID. It was like,
Right.
May, June, tons of gold stocks setting up. Well, so I took some positions. I'm not gonna one stock it might not interest me, but when I'm going through screens and it's just like, wow, you know, you gold name after gold name after gold name, and that is going to override my general dislike or historical poor performance, say in that group. If the market is yelling at me that hey, money is moving to gold,
Right.
I'm still going to treat it a little bit more like a trade, say, than I would something like technology that, or to your point about Tesla, um, you know, I would treat that more like a trade where I want to try and play a portion of it, for a bit more.
Right.
But it's always stocks first.
Perfect. Well, Mark, I'd love to just go through some charts with you and see how you analyze bases and also set those stop losses. So yeah, feel free to share your screen, and I'd love
Sure.
to talk about that.
So we can I'll start with some positions I have. Are you seeing this okay, Richard?
Yeah, trading views up.
All righty. We'll start with a position or two I currently hold. I don't have a lot on right now because, the last few days the market hasn't really been acting
Great. Yeah.
so well. So this is Revolve. I have a position in this currently, but I can show. So looking at a weekly, I'll go to a weekly first. You can kind of see here. I'm sorry, this isn't my normal. This stock has had a really big run, and then going all the way over here. This is sort of your primary
Base.
Really
Yeah.
primary base here. It kind of came out in the low 20s last year, and then just had a long, pretty nice run, and then put in, this multi-month base. And if you look, the accumulation was pretty good. And so on the daily, this, I'll look at the weekly, but I trade off the daily. This is that day base on a daily. You had this break in here, but it was met with some accumulation right here. A little bit erratic in this base, but then it started to kind of tighten up. And it first kind of came on my radar over here. And so I was kind of looking at this level as this is ultimately where the supply needs to, there's some supply at this level. It's
Right.
broken here. You use the, Mark's term VCP, volatility contraction, where you had a contraction here, a contraction here. Then you had another one right here. I would have preferred it to line up into this level, but it didn't. So I took a partial position on this day coming out. And then it ran right up to these highs and poked its head out here. I bought a little bit more, almost got stopped out on the add. So like if I'm going to pyramid up a position, I'm always going to be adding at the same price or higher, but only when I think the price action is improving.
Right.
So this was acting well. I bumped the position, and then it put in a reversal, closed pretty good here though, and then right back into new high ground. And this is something where, let's say you get a stock, it breaks out and pulls back into the range. If I'm being really aggressive, I might just trim it. And in this case, if I doubled up my position to a large size, I'd probably reduce that add-on at that point. I wasn't quite that aggressive. Plus this one, it was a little wider, meaning like this range here to here was about 7-8%, where that would be normal. I don't want that knocking me out.
Right.
But the best situation should come back quickly. It did, back in a new high ground. I sold a portion of this last week at around 20%, which is usually about 4 times my normal gain. Took about half the position off. Now I'm moved my stop up, and I'm at break even. But if we come down here much more, I'm going to look to move it up even more, or potentially use the 50-day trail. I like the space. I like the fundamentals, and this is sort of in that consumer retail group, which is a group I like to trade. From what I understand, too, their online stores are very popular. Sort of a lot of positives in terms of the sentiment there, and the earnings and sales are pretty good. So that's one. Another one.
Could I ask you some questions?
Absolutely.
On this one first? Sure. So I think you might have misspoke just a little bit. You said 20% is kind of 4 times your average gain. Is that your average loss that you were referring to? Around a 5% average loss, and then a 20%.
Yeah, I'm thinking. Sorry, yeah, 4. Yeah, so if I'm selling something at in the case of an average loss, it's a little less than that actually.
Yeah.
But if I'm around 20%, that's a 4 or 5 times my average loss. Sorry, yes.
Yeah. Perfect.
Yeah, I'm generally 7-8%. I try not to let anything run more than say 10. But 7-8% is usually that's a pretty hard line in the sand. And ideally, I'm not even going to carry the whole position to that point. I might carry part of the position. But if I get the timing wrong, I'm starting to scale back, sometimes 2, 3, 4%.
Right. And I want to hear a little bit more details about your stop loss levels initially when you first buy the position, and also as the stock makes progress. At what point do you move that up to break even? What point are you really deciding to sell a partial and then maybe move that stop even more under the swing low of the natural reaction? So I'd love to hear a little bit more about that.
Well, that'll lead me into the next example, but I
Sure.
can share it with this one as well. So, and this is where, like I said here, I bought a small position as the stock is coming through, sort of this pivot point here around $70.
Mhm.
Now, I was expecting the stock to potentially run into some overhead because you had this level, as I
Mhm.
drew before, which we hadn't got to, and then this other sort of reversal up here around 75. Now, I don't, again, we don't know what's going to happen. So I'd much rather have a small position on in case, because sometimes stocks just go blasting right through, previous supply levels or, resistance levels. In this case, it didn't. It came up kind of like I thought. Now my initial stop is going to be right down in here. So
Mhm.
again, it's a little wider. I'm buying at 70, stopping out at 64. That's 7 and 8%. Now, if it acts really poorly and I get a bad close, I might just cut a portion. Um, in this case, stock comes up and it didn't really tighten up a lot, but it lined up, sort of with this other level.
Yeah.
And so I said to myself, all right, I'll bump the position if it can come out and then use sort of these two lows as my stop for the bump. I wasn't going to cut the whole position there. So bump the position. I have a stop level here for that and holding the original stop. My average price is, now between probably 72, 72.50. And my average stop is going to be around 67.50, sort of similar, but I'm adding as the position is working. Where if you do that consistently, eventually you're gonna put yourself in a really good situation. But I would not. You could be more aggressive, and in some cases I would move my entire stop right up here to say.
Mhm.
And this is the only reason I didn't is this stock um, wasn't super tight, and in general the market has been a little bit. Um, a little bit wider and looser in some of these growth areas. So you got to make a decision. But certainly, normally, it is a fine tactic in my view. So let's say you bought coming through here at 70, and then and you took this much risk. Well, now I can double the position up here and move my original shares to this level is almost break even. So I'm effectively doubling my position while taking the same risk. Follow me
Right.
there?
Yeah.
This is a key point.
Yeah.
This is really how I pyramid my entire portfolio at times. And then once, to your question, when do I move? When do I move stops up? Once this thing follows through, then I'm definitely moving my stop up uh, to this level. Does that make sense?
Yeah.
And then once I'm at a multiple of my risk, so say I'm at 10% or something like that, if my average loss is 5, I'm then thinking of protecting break even usually, or
Mhm.
certainly not going to take a full loss.
Mhm.
And once I start taking profits, so I think I sold on this day here. I'm thinking I'm moving the stop to break even or better at that point, and sort of protecting, the entire trade to say I'm not letting this dig back into my pocket. And in this case, I would also switch over to the 50-day as well
Yeah.
to say, look, this is now at about my average purchase price. So I'm going to do break even, 50-day break even or better. You know what I'm saying? And that's how I'm handling this one in particular. And we're going into a market pullback here, at least
Yeah.
as far as the last few days. And this is how there have been plenty of times where I will sell a portion of a position. The market, if it tends to coincide with the market pullback, but it's a really strong name, it never comes back. So the ones that act the best, I try and give some room, but it's only because they're working, and I have already de-risked this trade, if that makes sense.
Right. Yeah, no, that's awesome. And I also wanted to ask you about how you use kind of multiple time frames to make sure the trends with you. We went from the weekly chart to the daily here. And I also wanted to ask you whether on the day of execution you're using something like an hourly, a 65 minute, even lower than a daily chart to execute?
Yeah. So when I screen, I'm always looking at weekly and daily, and that weekly um, I'm looking at the longer term trend. It needs to be
Yeah.
in a longer term uptrend, and then volume. I'd like to see ideally a larger that institutional volume, behind the stock. Um, as far as the intraday, I don't trade on it. I have it up here and there, but it's not something like I don't trade on the
Yeah.
intraday. I don't even look at a 60 minute. Um, I'll look at like sometimes if a stock gaps and then pulls back to a breakout where I wanted to buy it, I'll look at the intraday as it turns up and then occasionally buy it. But again, I don't trade off it. Um, as far as you know, moving to another example,
Hmm.
like so here's an example of this is actually kind of a proxy for like the overall. This is uranium.
Yeah.
I rarely trade the ETFs, but this has been in a long-term sort of uptrend. If you look at this on a weekly or a daily, and then it had just this explosive. This is a good example of a trade I de-risk that didn't work as well. It has this really sharp run, and puts in this cup and handle right here. And when this caught support right here and then kind of went tight for a day or two, my antenna went up to say,
Hmm.
okay, I am I'm I am looking to get involved big in the direction. I happen to know a decent amount about the fundamentals in this area as well. So I thought, okay, we're gonna have some fundamental support here, or at least potential buyers. So I was basically setting, an alarm right here and a stop right here. So this is like, $2-3 on a $90 issue, pretty tight. And I went in fairly large, right as it was coming out. And here is where I'm looking to finance. This was a trade either way, but I sold a portion, so if I'm only taking a $3 stop, once I'm at $6-7, I'm at a multiple of my risk.
Hmm.
Peel off half the trade, move the stop up to break even, and try and play it for a bigger move. Didn't work out in terms of the bigger move, but so then as it pulled back in, I got stopped at even. But this is exactly how I like to go overweight at times when I feel like the timing is really tight. Where most people, even if they bought this right here, would probably give it this low. And I would have done that if I was taking a smaller position. Or so the way I would handle it sometimes is let's say my normal position is 20%. If I'm going to go overweight, which would be 30 or twice, maybe double what your normal position would be, I'm going to be really tight on a portion of that
Hmm.
so that I am not. And this is where trading size, timing is everything, because everyone thinks, well, you just put on more size, I guess you make more money. It's like, well, yeah, but then you're also going to lose more money too.
Right.
So I want to be big when I think I really have nailed the timing. And again, if the market didn't do what I thought it was going to do, I was out. In fact, I took so big of a position on this day, I used the low of the day as it followed through.
Yeah.
So now we're talking, 91 down to 90, down to 90. I was taking a $1 stop on a portion of the position, and then this low on a portion of the position, and then this low. And so 2/3 of it, if it goes up $4 or $5, I'm in a multiple on that piece. Now that finances the whole trade.
Right.
And that's how, I will take this trade 1,000 times out of 1,000. The fact that it came back, oh, why didn't you sell it all at 100? Well, because I thought there was a chance it's going to 110 or 120.
Right.
I wanted to be there, paid for my normal, full size position with an overweight to allow me to do that. Does that make sense?
Yeah, 100%. I think that's a big key for everybody watching this. Listen to how Mark's kind of talking about financing the risk, taking big positions, managing his risk, so that often he has a large position size, but his normal risk that he's allowing himself to take is pretty normal, honestly. So it's increasing the position size, but not increasing the overall risk exposure, I guess is how I would describe it.
Yeah. And then,
Yeah.
the last, or, do you want to go over a few more examples? I can go over sort of a example from last year where sort of the stars all aligned in terms of fundamentals and technicals.
Yeah,
Uh,
let's do it.
this is a
And
lower. Go
And
ahead.
before we go into this one too in depth, Mark, I'd love to ask you. This is a little bit of the art in the chart, but I'd love to hear how you would explain how you identify those pivotal points where you want to take up the position, the pivot points. So with the uranium example, you're using that inside day high, but on another one, you might want a more well defined pivot point. I guess is
Sure. Well,
what
yeah,
I'm
we can
asking.
go over that real quick here too. So the uranium example is a little bit of it's a little bit of art and science. So
Right.
in our work, I'm running, and this is what I'm seeing in real time. So remember, I'm doing this in real time.
Yeah.
Um, the um, the high relative strength screens were showing a number of uranium stocks. The
Yeah.
problem was for me, a lot of them were low priced, $3, $5, $10. Um, so, and Cameco, ticker CCJ, was kind of the only individual stock, and it was also on the high relative strength. It's been on and off all year.
Hmm.
So this, I just happened to see this ETF, this because I don't normally screen for ETFs. Sort of coincidentally setting up as some of the smaller names were setting up. So for liquidity reasons, I liked this. And to my point earlier about like when I see a theme within the screens,
Yeah.
that sometimes leads me to the idea taken together with fundamentals. Well, here we go. You've got an ETF, which is pretty liquid, that almost doubles
Yeah.
and pulls back about 20, 25-ish%, right? This is a classic cup and handle.
Hmm.
Uh, and if you look, yeah, these volume bars, they look a little scary in terms of selling. They closed mid-range, but then if you
Yeah.
look at the right side, you had strong volume coming right back up. And then all this pullback, the volume was below average.
Right.
And so, yeah, to your point, we caught support right here and then went inside for 2 days. Here's your drift back, your little handle, and no real scary institutional selling. So to me, it's just one of these. Okay, if it should turn up here.
Right.
To thinking about it in terms of knowing what you need to see. Um, and this is just some of it's a function of repetition, but it's like I saw this and I was like, all right, it should be game on from here. Um, and if this is truly under accumulation, well, then you look at the first day, and you get that volume coming right out, which
Yeah.
moves it right back up. And this is actually another. I love trades like this too, where sometimes you can find this pivot point and position yourself where you can take profits before a stock hits new highs where you're still at a multiple. So if I was really tight here, I'm at a 2-to-1 before it even breaks out.
Right.
I love that. Then I can peel a piece off. And this is actually what I did. I was hoping it might even tighten up more right in here. It didn't. It just it drifted for 2 days and then came out. If it had drifted and tightened even again, then I would have loaded right back up.
Yeah.
And that sort of leads me to my next
Yeah.
idea is, so this is one where everything lined up for me in terms of technicals and fundamentals. This is Cresco Labs, which is like a U.S. multi-state pot stock from last year, where I happen to know a decent amount about the space, and these guys were in Illinois, I live in Illinois, and they owned all the licenses. So
Hmm.
I read some work on them, and some people who basically said, hey, the way Illinois did legalization is not like a lot of the other states, and they only granted so many licenses. So those who own the licenses have all the pricing power. And that was sort of really, it was like, okay, earnings power,
Yeah.
earnings and margins and sales are going to go up big time on these guys. Well, they were in this long-term downtrend. And so I'm just looking for a low risk entry point. Where can I look to get involved? And actually this was pretty creative. Sort of the first low risk spot. It was, the 50 had turned up. It had come off. I nibbled a little bit here, and then just kind of waited. But this then came down, and I mean, I basically traded around this position all last year and held the core of the position. So as it ran up, it came back, set up what Mark Minervini would call a
A
low
low
cheat.
cheat. Yeah.
I bought stock. I bought some right here. I didn't sell any into this move, and this was sort of like this was putting it all together. So you had a cup handle. Uh, I bought some coming out of this handle and added even more. I went overweight coming out of here. And if you looked, this stock coming out had, you know, this chart, you don't see it quite as well, but it had, it moved up. It was like 11 of 15 days on an increase of volume, everything to say, okay, I'm holding a portion of this for a bigger move. I did take some off in here because I was overweight. It tightened up. I bought some back, sold it into this move. And then when it went parabolic, I sold it down. Now now it has the biggest extension from the 50 in the entire move, and the stock has almost tripled from when I was first buying it. Now I'm using a 50-day trail on that remaining piece, close below the 50 over here, and we're out. What I was going to say though, around this time in terms of the cup and handle, these guys had a store that opened up near one of the big shopping malls near where I live. Full disclosure, I've never touched this stuff. I don't have any interest in, I'm a libertarian. It's like, if you want to go do that, that's fine. But I'm, not interested in getting high or anything like that myself. But I was just sort of curious, what kind of foot traffic, or, is this something that really is taking off? And it was right in here.
Yeah.
Cold night in Chicago. Out to dinner with my wife, and I go, I want to go at least see where the store is. That's on the outside of the mall, and just go pop my head in there, and the line was so long, it was out the door into the freezing cold. And my wife was like, "We're not getting in that line." And I couldn't believe it. I mean, it was like 8 o'clock on a Friday night or something. I mean, just out, just like you'd have thought people waiting for concert tickets or something.
Yeah.
And so large demand is basically what I'm saying. The thesis, it was what I was seeing in the chart was being borne out in terms of earnings and sales in real time, telling me that, okay, everything is kind of lining up here. Doesn't happen very often, but when it does, I'm going to be even more aggressive. And so, it adds conviction. I would never trade on that alone just because I go to the mall and there's people, out the door in a store. Doesn't, but if I see that stock setting up and it's in a group I understand, or it's a retail fad, or however you want to think about it, those are powerful, powerful situations. So yeah, needless to say, it worked out well. But I would encourage people that sometimes you have to go through enough reps to know what it is that you want to see. And then when you see it, there's just that intuitive sense of, I've seen this before, and it gives you the courage to either take on a little more size, or in my case, to stick with something. Look, if you've got a big position, you're going to have to hold through some pullbacks. But, again, from this breakout here and then this cup and handle, you didn't have any, it didn't really take out the 50 till you almost had a double.
Right.
So, yeah, that's how I played that one. We can go over, one other example if you want, whatever you think is best.
I think we've covered a lot, Mark, but I just want to say that story reminds me a lot of, I don't know if O'Neill went out and counted the cars in the parking lot in Price Company, or he sent somebody else out to do the research for him. But yeah, that just reminded me of that story where you're seeing the theme play out in real life, and the technicals, everything's coming together. So I think that's an awesome example.
And one of the people who I learned this from was David Ryan. I was at
there you go.
I was at the Master Trader program one year, and David, I can't remember, it was either before or after the seminar, had gone to Ollie's Bargain Outlet because they had one in Myrtle Beach. And I think it was like he, myself, Mark, like a bunch of people had all bought it around the same. It had this, people can look it up. It had a nice cup and handle sort of primary base setup. And David stuck with it. It continued to create another base and break out and go higher and create another base. It's a great one to study. And I think I traded it one or two times along the way. Well, I think David bought it and added every time it it kind of broke higher. And I remember, just sort of asking him about it. And he goes, well, every now and again, if there's something with good earnings and sales and it's a newer company and they got a store, I'll try and check it out. Well, I'm assuming he learned that from O'Neill, and this isn't anything new. It's just learning, sort of sort of confirming again what these charts are, for lack of a better word, sometimes just telling a story.
Yeah.
Well, you go to the store and there's nobody there, uh, uh, ever. And you talk to somebody at the store and they go, the place is a ghost town. My guess is the chart's not going to look like this. It's just, you know, these charts are discounting future earnings and sales, potentially good ones in the case of the stories we're talking about.
Perfect. Yeah, I think that's a great place to end the charting portion of this. And Mark, I want to thank you for going through that. That was really awesome. And I always like to end it off with kind of one last question. What general advice would you have for new traders just 1 year or a few years into this that are struggling a little bit? What kind of advice and inspiration would you give them to kind of push themselves to do the work and try to improve as a trader and become basically get on that path to profitability?
Sure, great question. Well, the first thing is, don't be discouraged when you make mistakes.
Yeah.
You're going to make mistakes. I've made plenty. Uh, Anybody who tries their hand at this game is going to make mistakes. You want to learn to correct them quickly. And then the other thing, I think most people overestimate what they can do in the short run and underestimate what they can do in the long run. I know lots of people, make this quote. I know Tony Robbins makes it. I've heard Mark Minervini make it and others. But the idea that, okay, I'm going to make, I'm going to take, a small amount of money and turn it into, a huge fortune in a year is probably not realistic. At least with good principles. But that ability to stick with it, to persevere, and to learn and grow. Look, there's no shortcut to experience. Uh, some of the lessons I've learned, and even the things I've read, the seminars we talked about, and those types of things, hugely important. But you have got to go through that process of learning those things, get in the ring, if you will. And the other thing, though, I think people think being small. The other thing I would add, being small is an advantage.
Right.
Yes, you may not have much, but you can get in and out so fast. You've got no liquidity restrictions. You can run up small accounts easier than you can big ones, but that doesn't mean you have to take more risk. People think, well, once I get to a $500,000 account, $1 million account, then I'll stop taking so much risk, or stop being irresponsible. I think that's crazy. What you need to manage a small amount of money the same way you manage a large amount of money, i.e., with respect for risk, thinking about the downside first, and building it up responsibly. Because if you get rewarded for bad habits early on, they're just going to get reinforced. And then if the market really does, deal you a big blow, it's going to be at a much higher level, and potentially be more financially and emotionally destabilizing than you're going to be able to handle. So, yeah, don't be afraid of small beginnings, and don't don't underestimate what you can do if you stick with it.
Perfect. Well said. And Mark, I know you're not super into social media, but are there any places that you would point people to if they want additional resources and learn a little bit more about your style and how you trade?
Sure. Yeah. Well, I don't do a lot of, I don't have a personal Twitter because of some constraints regarding the CTA and things we manage.
Yeah.
We tweet a little bit at RTM Advisors. But I do some education as well. Helping Mark Minervini out at Minervini Private Access. Obviously, if you want to learn how to swing trade equities from the long side, I think he's one of the best follows. And his sort of education and materials are had a big impact on me. So yeah, you can take a look there. You can also visit our website if anybody's looking for what we're doing there. It's rtmca.com.
Perfect. Mark, I want to thank you so much for taking the time and talking with me. I really enjoyed this. It was a great discussion. And I'm sure everybody watching did as well. If you did, go ahead and leave a like down below and subscribe if you want to see more great interviews like with Mark Ritchie here. And Mark, with that, thanks so much again. And yeah, take care, everybody.
Thanks, Richard.